Good evening, everyone. I'm your host, Avette Ingleton, and tonight we're keeping things real and focused. We're taking a clear look at what the market is actually doing this year. The steady performers, the reliable blue chip names, and the long-term strategies that truly move the needle for everyday investors. And we've got a special guest joining us a little later, someone who knows long-term investing better than anyone I've ever spoken with. So let's jump right in. Now, before we dive into the charts, I want to say this. There is absolutely nothing wrong with waiting. When the market feels uncertain, sometimes the smartest move is to step back, stay patient, and keep building up your buying power. Think of it like a photographer lining up the perfect shot. They don't just snap the camera the moment they show up. They study the light, adjust the angle, breathe, and wait for everything to line up. Investing works the same way. You don't rush in just because the market is moving. You prepare. You build your arsenal of cash inside your brokerage. Stay disciplined and get ready for the moment when the setup finally appears. Because when that moment comes, being prepared is everything. And to really show you why patience matters, let's look at Modine this year. On January 2nd, it was trading around $116 a share. By January 22nd, it had already pushed past $140, and a lot of investors were chasing it at those levels. But then came the pullback, a real one, and by April the stock had dropped below $70. That was the moment to act. And honestly, even if you weren't ready to go all in, simple dollar cost averaging during that period would have been the smart play too. Because by October, when Modine climbed back above $160 a share, anyone who stayed disciplined, whether they bought the dip outright or DCA'd their way through it, walked away with incredible returns. Same stock, same year, completely different outcomes, depending on whether you chased the high or prepared for the opportunity. And that's really the takeaway. Patience and preparation always win. Now, to go a little deeper on this, I want to bring in someone who's lived these principles for decades. Jeff Prince, founder of Prince Capital Group, a true architect of long-term wealth and the mind behind the three pillars philosophy. He's guided institutions, mentored fund managers, and built strategies that have stood through multiple market cycles. Let's give him a call, because his perspective is exactly what this moment calls for.
Good evening, Avette, and cheers to you and the CCI community. I've been watching the conversation, and I have to say, it's refreshing to see patience and preparation getting the spotlight.
Why, thank you, Jeff. We do our best to keep the family informed on the steps that really matter. And trust me, we've been watching your moves as well. You've been spot on as usual, I see.
Well, I appreciate that, Avette. I've simply been around long enough to recognize the patterns. You know, markets change, but the principles don't. So I'm here to share what time has taught me.
And that's exactly why I wanted you here today. Jeff, new investors hear the noise. But you've lived through the real cycles. You've seen the booms, the crashes, the hype phases, all of it. So before we dive into charts or headlines, what's the first principle you think every new investor should understand?
If I had to start anywhere, Avette, it's with discipline. Markets will tempt you, scare you, and try to pull you off your plan. But discipline is what keeps you steady. And right behind that is patience. Everyone wants the quick win, but remember that real wealth shows up for the people who stay in the game long after the excitement fades. And the third principle is simple. Don't chase, not trends. Because just like in life, trends fade fast. Not tips. By the time you hear one, it's already too late. And definitely not headlines. Most of the time, they're designed to push you exactly where the market wants you to go. Stick to your plan, stay patient, and let time do the heavy lifting. And to tell the truth, I didn't learn these principles from textbooks or classes. I learned them the hard way. When I first started, I chased everything, every trend, every hot tip. anything that made me feel like I was missing out. And every time, the market reminded me exactly who was in control.
Jeff, hearing that really puts things in perspective for a lot of beginners. But it does make me wonder, with everything that's been happening lately, a lot of people think the market is going to react negatively during the first half of the new year, maybe even crash or pull back hard, and that makes them nervous about investing. Is that actually how a new investor should be thinking about it?
Actually, it's the opposite. Avette, if or when the market does pull back, that's usually the best time for new investors to get their feet wet. A pullback isn't a danger signal. It's a discount sign, but most beginners don't see it that way because fear kicks in and the headlines start screaming. What they don't realize is this: every long-term investor you admire built their wealth by buying when things felt uncomfortable, not recklessly, but consistently. A pullback simply means you're paying less for the same quality companies, and if you're patient, those moments become the foundation of your future gains. And you said something at the start of the show that I really agree with. There's absolutely nothing wrong with waiting. When the market feels uncertain, sometimes the smartest move is to step back, stay patient, and keep building your buying power. That's not hesitation. That's preparation. So no, new investors shouldn't be thinking, the market might drop, I should stay away. They should be thinking, if the market drops, that's my chance to start small, stay disciplined, and let time work in my favor. That mindset shift alone can change someone's entire financial future.
Jeff, that perspective really helps beginners understand the bigger picture. It also makes me curious. With the way things have been moving lately, do you see the market leaning toward any particular sectors? Or even the AI boom, does it still have room to grow? A lot of people are trying to figure out what areas might offer real opportunity right now. And if you've got a moment after that, I'd love for you to take a quick look at our blueprint portfolio, the one we're growing from $100 to $1,000, just to see if we're heading in the right direction.
Oh sure, Avette, I'd be honored. And as far as where the market seems to be leaning, I'll tell you this: money doesn't disappear, it rotates. When one area cools off, another starts heating up. Right now, I'm seeing strength building in a few places: industrials, energy infrastructure, and anything tied to real productivity gains. Take Modine, for example. That's a company benefiting directly from the demand for thermal management and efficiency. And I've noticed you two have been holding that one with a long-term mindset. That's exactly the kind of name that thrives when the economy shifts from hype to real output. And on the energy infrastructure side, Quanta Services is a great illustration. They're the backbone behind grid upgrades, transmission projects, and modernization work. Not to mention we're the largest contractor for U.S. electric utilities. When the country invests in strengthening the grid, companies like Quanta are the ones actually doing the work. That's why they tend to hold up well when capital rotates into the build and improve part of the economy. Now, the AI boom, that's a different conversation. I don't think AI is fading. I think it's maturing. The hype phase is over, and now we're entering the prove-it phase. The companies that actually use AI to make money, save money, or scale faster, those are the ones that still have room to run. Not just the flashy names, but the picks and shovels behind them. Take Palantir, they're not selling hype, they're selling outcomes. Governments and major enterprises are using their platforms to make real decisions in real time. That's utility, not speculation. NVIDIA is another example. They're still the backbone of AI infrastructure. Every major model, every training pipeline, every data center expansion, it all runs on their hardware. They're not just part of the AI boom. They're the toll road everyone has to pay to use. And then you've got companies like Applied Digital. They're building the high-performance data centers that AI actually lives in. As demand for compute keeps exploding, the companies providing the power, cooling, and infrastructure become just as important as the chip makers themselves. And your blueprint portfolio, of course, I'll take a look. Turning $100 into $1,000 is tough. But you're picking real companies with real strength. Let's walk through it and make sure you're set up to handle pullbacks and keep growing the right way.
Jeff, that was incredible. The way you break this down just makes everything click. Let me pull up our blueprint portfolio so you can take a look. I'm really curious to hear what you think about the path we are on. for our viewers.
Now, looking at your blueprint portfolio, SMCI, Wolf, Joby, GE, VU on MD, and ET, you've actually built something with layers. You got growth, innovation, stability, and income all working together. That's a smart structure for a $100 to $1,000 challenge. On MD's the one I'd phase out for now. The fundamentals just aren't lining up. Low volume, dilution risk, and weak revenue momentum make it tough to justify in a portfolio that needs velocity. Doesn't mean it's a bad company, just not the right fit for this stage of your journey. Now Wolf. That's a different story. I'd stay optimistic there. It's been on a strong run lately, and that's tied directly to improving sentiment in crypto and the shift toward cleaner, more efficient mining. If Bitcoin continues to recover, miners like Wolf tend to move first and move fast. It's volatile, sure, but volatility cuts both ways. As long as momentum stays constructive, Wolf can be a real growth engine in a small portfolio like yours. SMCI gives you a AI infrastructure exposure. Joby gives you a moonshot with real engineering behind it. GE gives you a rock-solid industrial anchor. VU keeps you grounded in the broader market. And ET gives you income with rate cut upside. That's not luck, that's intention. And intention is how you turn $100 into $1,000 without losing sleep. So all in all, this portfolio is looking strong. You've got balance, intention, and real growth potential. Just that minor adjustment with OnMT, and you're golden. And I'll tell you something else. This channel you're building, it's special. It's going to grow and fast because you're teaching people the right way. And since you're phasing out OnMT, here's a name worth looking into. Autoless. It's a real biotech with real clinical trials in next-gen CAR-T therapies. And that sector has produced some of the biggest multi-baggers in history when trials hit. They've got strong trading volume, so you're not stuck in a dead ticker. They're already showing momentum. And institutions are paying attention because CAR-T is a hot space. And the fact that it's under $10 makes it an interesting candidate for a small, high-velocity portfolio like yours.
Jeff, thank you so much for your wisdom today. Truly, I know you're an incredibly busy man, so we appreciate you taking the time to sit with us and even look over our portfolio. We'll definitely be implementing your advice and keeping you updated as we grow. And of course, we'd love to have you back on the channel again whenever your schedule allows. And to everyone watching, thank you for spending this time with us. Please like, comment, and subscribe. It really helps the channel grow and lets us keep bringing you conversations like this. We appreciate every single one of you. And just a quick reminder, even though this creation is fictional, the information we share is absolutely spot on, reliable, and essential for anyone serious about their investing future. But remember, investing always carries risk. So if you're ever unsure, make sure you seek professional financial advice. Have a blessed and financially successful week ahead.